Welcome to Mandia Trading, everyone. Today we're going to be looking at the options profit calculator and how you can use it to analyze your option strategies before you enter into a position. Now, from the home screen here, notice you're going to have the basic option strategies. You have the spreads, advanced iron condors, butterflies, diagonals, and straddle strangles. You can also go custom depending on how extensive your knowledge is on options. So we'll start with the long calls, which is on the bullish side. When you click on that, it gives you a little bit of a brief description of what the strategy is. The symbol selector box here, we will go with Wells Fargo. You can plug in any ticker symbol in here for you to analyze. Click on get price. It will show you the current price of the stock you're looking at. Now, what you want to do is click on select option. You want to set this to buy and then select option. You will have a dialog box that's going to pop up on your right side that shows you the expiration dates up top and the calls on the left side, puts on the right side, and in the middle you have your strike prices. We want to look at the January 2023. Mind you, you can select any one of these expiration dates according to your option strategy. So we'll go with the January 2023 and select the 47.50 strike price, and we'll go for the mid. You have the bid, mid, and ask, but in this case we'll go for the mid. Click on that, which will cost us $3.13, equating to $313. Sometimes if it is your first time using this tool, it'll ask you to agree to the terms and conditions. And if you want to use this, you had better agree to those terms and conditions. You click on calculate and it gives you visual representation of how your option profitability is going to look like with time decay. So on the left side, on your y-axis, you have your price action. On your x-axis, you will have your time decay, and these values in here basically show you your profitability as time goes by with this option strategy. You have a diagonal line in this case that shows you your profit area and your loss area. So if for all this price of Wells Fargo were to go up to 48.80, you can see that you'd be looking at a 39% profit. And if it maintains the same price, by the time you hit September 29, you'd be looking at a 28.4%. So each and every one of these numbers you see at a glance represents the percentage of profit you would look at. So the red territory is essentially losses. The green territory is essentially profits. And of course, the further out you go towards your expiration date, you would see how your profitability will be affected by that time decay. Okay, so this is the call strategy, long call strategy. Now, I have so many tabs up top here because I wanted to show you the difference between call strategies, puts, and whatnot. So we'll look at the put strategy, long put, which is more on the bearish side. We'll still maintain Wells Fargo. We'll click get price, buy. Of course, we want to buy that put. We say select option, and of course, we'll stick with the January 2023. And would be on the put side as opposed to the call side. So on the put side, we want to just be close to the current price. So we'll say the mid at a $45 put. We click calculate, and it shows us how the profitability will change from a call strategy to a put strategy. So in this case, if the price action is more on the downside, that is your profit territory. And if it maintains a neutral price or price action is on the upside, you'd be looking at a loss territory. So this is how you can look at how your profitability or how your option is going to behave with time decay. So you can hover over any one of these numbers and kind of scroll to show you how your profitability will be affected with that time decay. So you can see the difference between this put strategy and this call strategy. Okay. Another strategy I can give an example on would be the call credit spreads. Okay. Call credit spreads would be neutral to bearish strategies. Okay, neutral to bearish strategies. So if you expect the price of a stock to remain neutral or be on the downside as time goes by, this would be your strategy. So if you click on call credit spread there, we'll stick with Wells Fargo. We'll put that ticker symbol in there, get price, select option, and we'll stick with the January 2023. How about that? We'll stick with the January 2023. That way we keep it simple. Now, for the call credit spread, you want to sell a strike price that is closest to the current price, and you want to buy a strike price that is a little further away from the current price. Okay, now since this is the long call, this basically means this is the call strike price that is a little further away from the current price. So we'll go with 55 in this case. Click 55, and then of course the short call, we want to set it to right. Anytime you see right in there, it means you're selling that option or strike price. So we click on that and want to sell something that is closest to the current price. We'll go with the 47.50 just to keep it simple. It shows you the difference in pricing of those two options, and of course this is the net credit you would get from this strategy. You click on calculate. This is a graphical representation of how your profitability will be affected with time decay. Now, being that this is a neutral to bearish strategy, it basically means that even if Wells Fargo maintains the same price with time here, you would still be looking at a profit territory. And of course, if it goes further on the downside in terms of price action, that is even a little bit more profit. But of course, this strategy comes with a fixed profitability of that net credit that you would get. So this basically just shows you how the profitability would be affected by the time decay. So if you compare this call credit spread to a put, you can see that for a put, you do not have any leeway if the price of the stock remains the same for an extended amount of time, whereas a call credit spread gives you that leeway to say if it remains the same for an extended amount of time or goes on the downside, you'd still be in a profit territory. Another example I'll show is the put credit spread, which is a neutral to bullish type of strategy. Okay, once you click on that, you click on put credit spread, of course. You want to search Wells Fargo or any ticker symbol. We'll click on the select option. We'll stick with the January 2023. And then of course, for the put credit spread, you want to buy a put that is further away from the current price and then sell a put that is closest to the current price. So since we're on the long put, in this case, we want to, let's say, buy the 37.50 put, and then we will write or sell the $45 put, which is priced at $3.15, and this would be the net credit we would receive for this strategy. And of course, when you click on calculate, it will show you how your profitability will be affected by that time decay. If it remains neutral, you would be in profit territory. If you see price action on the upside, you maintain that profit territory. Now, of course, comparing this to a regular call, you'd see that you have more leeway in terms of the profit territory as opposed to this call. You wouldn't have any profit territory if this price remains neutral for an extended amount of time. So that is the difference between the strategies, and just to show you how different these graphs would look like whenever you're analyzing different option strategies. So this tool is very nice to have. It gives you a nice representation. It can give you a nice approximation as far as when you would want to sell some of these option strategies rather than holding them indefinitely. Please go ahead and like, comment, subscribe. We shall have some more videos coming for you. Thank you.